When you start analyzing a market's price action, and more specifically their swing points, which in this market they are repeated lower highs and lower lows, so basically a straight and simple downtrend. Nothing outcomplicated so far. But the problem begins when the market reverses. That reversal is seen with an upwards push that breaks above the last lower high, turning it into higher high. As most of you know, especially my regular viewers should know, is that when the market has been following a downtrend, and then after a long time, it finally breaks into a higher high, this first break is called a bullish trend shift. This simply indicates that the market has a high probability of now reversing the swing points, which would now form higher highs and higher lows. So knowing this theory, most traders, and especially the smarter traders, would look to buy this market from a support or demand, which is most of the times found near the swing lows. The placements of the stop loss has a proper logic, being below the demand. It has logic, because since you're now expecting higher lows, you're basically saying that the market should not break below the past low, but it should form the swing low, above the past low. And the logic of the take profit is simply respecting the uptrend fundamentals of repeated higher highs. Opposite as we've had before, when we've had lower lows. On uptrends, we see higher highs instead. And we see the market pulled back into the demand or support, filling the order. But then we see this, a continuation of the downtrend, stopping us out of the trade on a loss. So the question is, what was the mistake? The reality is that very few have paid attention to the formation of the swing points. Look here, we have a low, but then we have a lower low after, and it's from this low that we have later seen the push into a higher high. The problem is that up until this point, we do have a higher high, but we do not have a higher low. The mistake was not waiting for the first complete uptrend formation to validate. What we should have waited for to validate a potential uptrend is to wait for a pullback that should later be followed with another break of the high. This upside break forms the break of structure, and that validates that this is now a strong higher low, which is later followed with a higher high. So now we have both swing levels pointing towards an uptrend, and it's only now when we can look for a demand or a support level near the past swing low in order to take this market higher with a buy position. In this market, the moment we've seen the market breaking below the past low, that's when every bullish scenario should have been ended, since we do not have both a higher high and a higher low in order to sustain an uptrend. Now here, we initially got an uptrend, with pretty clear higher highs and higher low formations, from where on each higher high we validate bullish breaks of structure. But it then fails to form a higher high, and actually forming a lower high, shortly followed with a lower low, this breaking down into a bearish trend shift. So this time we actually had both, a lower high and lower low, so we got both characteristics of a downtrend respecting, which is the reason why you see after that, the market went lower into forming once again a lower high and a lower low. But then after, the market broke into a higher high. But keep in mind, we don't have the higher low yet. So yes, this is a bullish trend shift, but it might not be enough to get high-quality buy-long positions. And we should wait to confirm a valid and strong higher low that should later follow this type of price action, which is characteristic of an uptrend. Now we can still use support and demand levels, but just not for the entry, but more so to know the levels where the market should pull back, because usually demand and support levels on uptrends are found on the higher lows. For example, we can look on the left, right on the last lows that we see, and identify a support or demand there. If you're looking for a demand, that should be the last downside candle, right before the impulse to the upside. The demand should be around here. Now there is also another problem here, which is the demand level being larger. A larger size demand level can confuse us because the market has basically more space to bounce from. So it's harder to try to predict the exact moment of reversal, and also if we're planning the setup based on the same logic as the other demands, so the entry placed at the top of the demand with the stop loss below the demand, or even below the past swing low. In this case, in order to get a decent risk to reward, we need to target the extreme swing levels. For example, a break above this high, and this is not even a decently high enough ratio. And if we're looking for more, for example a 1 to 2 or 1 to 3, this setup will take a lot of time, entire days, maybe even weeks. Later the price fills the demand, and we got a bounce to the upside. This bounce breaks above the past high, marking the first bullish break of structure. After a bullish break, we want to wait for the market to pull back. And well, the problem here is that this demand is too large, and we can't know where the pullback will end. For example here, we got 3 bearish aggressive candles. These candles have broken the last low. That is not so important in this case, because we've already had lower lows internally. What actually matters is to not have lower lows on the swing points, so the market has to avoid breaking below this low. If it manages to do so, we're holding a potential uptrend, and if it does break below the swing low, the market continues the downtrend, making this upside price action as a trap, liquidity grab, or simply noise of the internal price action. And looks like this might be it, with another bounce out of the demand, which also breaks the past high, and later followed with a bullish continuation. Now that we've confirmed the uptrend, we wait for a pullback, and that should allow us to validate a demand or support where we can enter a position. For example, if we analyze the recent price action, we have an upwards push, with a very small downside pullback that shortly after gets faded to the upside, into a higher high. And the final move is this bearish candle. Now, knowing we're now confirmed into an uptrend, we want to see higher lows. That means that this low should not break. In other words, we would expect this bearish candle to reverse to the upside pretty soon. Now, the thing is, we don't really see a high-quality demand in this specific time frame. So what we can do instead is to move into a lower time frame, since there we can see the same price but in more detail. This being the same price action but inside the 15-minute chart. Now here we have this choppy price action, so we can't identify proper demand levels or really anything important. So we look at the continuation because we had a clean upwards push, followed with a small downside pullback, and continuation that broke the past internal high. The break of the past high validates a break of structure, and the break of structure validates a demand, which is the last bearish candle before the upwards impulse started to happen, being this level as the internal demand. Then we've seen a very similar price action repeating again, basically an upwards push, with a very small pullback, that is then followed with another break of the high, and again the same story, having a break of structure and validating a demand internally. And this demand has actually already played out if you look closely. The market rejected back to the upside right from filling this demand, and if you plan the setups like I've told you many times on the channel, this was not a complicated setup that worked well. And to the upside, on this entire price action, we don't really have significant demands or anything important to use as an entry level. It's sort of a continuous increasing market, but without forming any opportunity on the pullbacks. So we're pretty much left with only a demand level that has not been filled yet, which is the first one that we found when entering into the 15 minutes chart. And we're having the market currently approaching this demand, and the reason why this is a higher quality demand is because it's really the only one that's also closer to the current price. And we also have proof of concept that demands did work recently. So we can plan the setup with a buy-long position from this demand, stop loss below the demand, or even safer, below the swing low of the demand. And we need to think about the take profit. A way to exit with a logic is taking profit on potential supply levels. For example, this might be the first one, but the risk-reward ratio is not that great. There is also another potential supply right above, which increases the risk-reward ratio of the setup. Now it's better, but there is the final internal supply from above. This one is slightly more risky, but given the fact that we're in a high time frame uptrend, there is a higher probability of the market breaking to the upside, so we can form the swing higher highs, because this potentially might be the swing higher low, and we know that in uptrends, after higher lows, higher highs must form in order for the uptrend to hold. So far we've got a nice bounce, getting closer and closer to the take profit. We're now seeing a pullback, no need to panic, especially because right after the pullback, the market pushed much higher, eventually moving into the take profit, breaking into the high, and even going higher. So if we zoom out, we see that this price action was nothing complicated, because it was simply just a continuation of the higher time frame uptrend. Let's see on this market, this time we're in a low time frame, so we can experiment both, starting from a higher time frame, and now from a lower one. And by doing the structural analysis of the swing points, we see multiple higher highs with multiple higher lows, and this happening up until here, where we got a lower high that gets confirmed after we break into lower lows. We see that from the maximum swing high to the next pullback to the downside, there is a break of the previous low, but the candle closure happening slightly lower on the next candles, meaning a couple hours later. And it's really the candle closure that confirms the market structure shift. Now here, the market filled a supply right after the break, which in this case happened to work, but just so you know, a break is valid only if it comes with a candle closure. And there is also another supply here that got filled in the last candles. And there might be even more that are higher quality, And to identify more supply zones, we can implement the strategy that we've done before. So basically lowering timeframes to see the price action in more detail. And since it's a low time frame to begin with, we will just move down one tier, so into the 5-minute chart. So right here, it's where we got candle closures below the range, with the last candle looking like it's about to pull back to the upside. Now, of course, a pullback in a downtrend will many times reject from a supply, or from a resistance. And an available supply that we can see on this price action is right at this level, being the last bullish candle before the aggressive bearish action started happening. And more often than not, the pullback ends on a supply, which should be later continued with a downwards push that breaks the past low, forming the first bearish break of structure. But keep in mind, entering a sell-short position from this supply is still risky, because we've had the trend shift that formed the lower low externally. But so far, we don't have the external lower high, because this is an internal lower high. We have the pullback right now. Now this pullback wasn't strong enough to even fill the supply, and it actually broke lower before filling it. But if you look closely on the price action formations, we're constantly having lower highs and lower lows, more so internally. But on the last price action, if you look at the local highs, the rejection to the downside happened because it filled a newly formed supply from a recently formed pullback. So now we have two main things happened and are very important. We got a break below the lows, which now formed the external bearish break of structure, and after a break, a pullback should be met. And the other thing is that we now have a proof of concept that supply zones are starting to respect, to look for a supply, and more specifically one that didn't filled yet. We look at the last price action, because here we see the same type of pattern, an upside push that later gets faded down, and we have the supply formed from the last bullish candle. And it's now when we can plan a setup, since we already have the previous supply that worked out. It increases the probability that even more will respect, at least in the short term, so entry on the supply. Stop loss above the past high, since this is a lower time frame. I place stop losses above or below swing points instead of the above the supply, because a random wick can just stop you out of the trade, and the lower time frame price action usually has more of these types of wicks. And the take profit, structurally, should be below the last low. However, having a pretty low risk reward, we can look on the left of the chart on the external price action, and we look here for levels to target. For example, below this swing low, this increases the risk reward slightly. There is another swing low here to be taken down, and this one is much better. And the same logic applies to the other ones as well. I wouldn't go lower than this one, since even this setup has a great ratio. But if you're more risk-seeking, you can target whatever level you'd like, because the high time frame is in a downtrend. So structurally, a lot of these lows should be broken to the downside. So let's come back into the recent price action. And as I said before, we have three potential levels for the take profit. The first one from above, which is not that great. The one from below is better, and actually pretty standard setup. A 1-to-2 ratio. Common between many strategies. But if we're doing such a deep analysis, I would target for slightly more, being the third one from below. The order fills very quick, breaks the first two levels, and the last one as well, closing the position with a win. And also it forms a clear downtrend price action with their lower highs and lower lows. And you can see how the pullbacks ended on supply zones, from where that's exactly the moment where the market pushed to the downside into continuing this downtrend. And on the last candles, we see that it's now trying to pull back. Of course, that's because after any significant break, a pullback should be expected. And as before, continuation towards lower lows, the break validates a supply, and we've seen multiple supplies that have worked recently. So again, having a similar setup planning, identifying the last supply and selling short down from it. The position gets opened, and we see how from an internal uptrend we now flipped into an internal downtrend right after filling the supply. We're forming these lower highs and lower lows, and all we need is patience and attention for the market to not reverse, but to keep holding a downtrend, which it does, to eventually close on another win a couple hours later. And you see that this can be done once again, because on the internal price action, we have supply zones that filled and respected. But keep in mind that the reason the internal price is respecting is also because the external one is bearish. Basically, they're both moving in the same direction, they're having the same trend. But to keep doing this, you need to know how these concepts work in confluence, so you can identify the highest quality setups. Those are setups that have an increased win ratio with a high risk-reward ratio. Both together, while also being simple to identify these setups, and they become much simpler to spot, Especially my traders using my resources, they shouldn't find it difficult to spot these opportunities. If you're interested, take a look at the link in the description and see you on the next video.